This week, yet again, has plenty of potential market movers for sterling. So with us down the line to share his insights on the latest UK economic events is Simon French. Simon, after an election hailed as the most uncertain in decades, transpired with the first single-party government in years, the latest IP data now suggests the UK is benefiting from the oil and gas situation as extraction surged. What is your take on the latest events?
Yeah, so the general election was broadly welcomed by the business community. The coalition government that preceded the current Conservative majority government was very pro-business. It managed to cut the corporation tax from 30% to 20%, and markets enjoyed the continuity of the Conservatives moving from being majority coalition partner into a majority government. And you're absolutely right, nobody saw this coming. A lot of people have come out of the woodwork since, suggesting they did see it coming, but they were very quiet before Thursday night. In terms of what that means for the UK going forward in this economic situation, we had some industrial production data out this morning, which saw good, strong growth, and you mentioned the beneficiary of the oil and gas price falls, and that reflects where the UK is right now. Despite its oil in the North Sea, it is an oil and gas importer and therefore has benefited in terms of its trade balance from the fall in the oil and gas price. But that's also put pounds and pence back into the pockets of consumers, and we are a service-based economy in the UK. 76% of economic growth comes from services, and therefore the disposable income that consumers enjoy has really pushed the economy on in recent quarters.
NIESR lowered their growth outlook before the election, but Q1 GDP still disappointed. Do you believe the UK economy will at least rebalance moving forward?
Yeah, so in Q1, the UK grew by 0.3%, and that was slightly below expectations. You mentioned the 0.6% figure, and most people, neither included, expected that as the growth rate. I think growth will rebound in Q2. A lot of the survey data that's come out in recent weeks points to a recovery in the manufacturing and construction sectors, which just held back growth in Q1. In terms of rebalancing, the current government have a target to increase UK exports to £1 trillion per annum by 2020, and that's the big Achilles heel. If the UK economy has a weakness, it is on its export performance, and the progress to rebalance and cut that current account deficit will be determined by our ability of the export markets to compete with a Eurozone which has also benefited from a depreciation in the value of the euro. So while the economic backdrop is strong in the UK, there is that international dimension which will really complete the full set of a healthy economy.
The data was sandwiched between the latest Bank of England rate announcement, no change there, and a day before Mark Carney will publish new forecasts for growth and inflation. What are the markets hoping for from Carney?
Well, you're absolutely right. At the start of the week, the Bank of England came out with its 73rd successive quarter of unchanged data, keeping interest rates at 0.5%. Now, looking forward to the inflation report, which is coming out tomorrow, Mark Carney will be looking to signal to market participants the future path for interest rates. Now, up until about 6 months ago, there were two members of the Monetary Policy Committee who were voting for a rate increase, and therefore the UK, along with the US, was at the very forefront of those economies across the globe that were looking to tighten monetary policy. Now, then came the oil price collapse, commodities price collapse, which pushed the timetable back again for interest rate rises. But we're now getting to a situation with the labour market tightening, a return of real wage growth, that most analysts, myself included, expect the Bank of England to act and start raising interest rates in Q1 of next year. So this is the time, the inflation report, when we see a lot of the underlying data that will inform the Monetary Policy Committee decision. And Carney will give a further update on where that path will start to commence to rise from the 0.5% current level of interest rates.
If sterling gets another lift from tomorrow's wage and unemployment data, that may, according to some, provide a peak in pound-dollar. What is your outlook for this pair?
Well, this morning the pound broke through the 156 barrier against the US dollar, and that was on the back of that industrial production data that I mentioned earlier. And the longer term prospects for the pound are fairly strong, certainly with doubts over Greece and the sustainability of the Eurozone. And the sterling does have a safe haven status, which is enjoyed since the beginning of the Eurozone project. But also with UK rates being alongside the US, the only two major economies that are expected to increase interest rates, there is the hot money flowing into the UK on the anticipation of rate rises down the path. So I have a view that by the end of the year we're looking for 165 as a cable rate, and that's an increase from where we are today. And that's a combination of those two factors I've mentioned, and also a strong domestic economic backdrop.
Simon, great to speak with you. Thank you so much for your time. Well, that's all from Simon and myself, but for more insights on oil, please do click back for our Commodities Corner with Sam Meredith. Goodbye for now.